much would you pay for a share of stock? How about $1,000? Well, two of the more popular stocks now on the market reached that price tag. U.S. Bank Vice President and Senior Portfolio Manager Mike Denneman joins us in this week's U.S. Bank Economic 360 to talk about those stocks. Mike is with Business Courier editor Rob Dawmeyer in the studio. Gentlemen.
Thank you, Peg. Mike, let's end the suspense. What are these two stocks?
Cut right to the chase,
yeah.
Right? So the two stocks, and it was just very recently, the last few weeks. First was Amazon, and then followed very closely on their heels by Alphabet. Alphabet being the relatively new corporate name for the parent of Google. Right. So both of those crossed the $1,000 mark. In some ways, not a surprise. Both of those have been stocks that have been very hot the last couple of years, so the share price has been climbing. But on the other hand, it does grab headlines because we just don't see that many stocks trade above $1,000 per share. To put that in context, the average share price of a stock in the S&P 500 is about $90. So clearly 1,000 is well above that average. And again, that list of quadruple figure stocks is just really small.
And why is it so small? Why don't we see more companies with share prices at this level?
Well, and see, that's the interesting thing. There's nothing magical about that $1,000 price level. There are many stocks that would get there eventually on their own if they were just let be. And what I mean by that is that for the longest time, it was seen as something of a drawback to have a share price where the dollar figure was too high. I think the idea was that investors are more likely to buy shares if they see them as being reasonably priced as opposed to having this huge price tag. So companies would periodically undergo what we call a stock split in an effort to keep that share price lower. You increase the number of shares outstanding. That has the result of pushing the share price down. Nothing shady about it, completely above board, but as companies would see their prices climb, they'd periodically undergo these splits to keep the price down. A great example is Apple, much publicized split just a few years ago by a factor of 7, so they reduced their share price significantly. Ironically, had they not done that, they would be above $1,000 right now. But we just don't see share prices, they're not viewed the same anymore, and so these splits aren't nearly as commonplace today as they were, say, 10 years ago. So that's why we're starting to see some of these prices climb higher and higher. So
is Amazon and Apple, are they going to be the pinnacle? Are they the most are they going to get close to being the most expensive shares you can buy?
Yeah, no. So clearly paying $1,000 for one share of stock is very high.
Yeah.
But even knowing that, they're not even in the same ballpark as the highest price shares. That distinction belongs to, and frankly has belonged to for a very long time, the so-called Class A shares of Warren Buffett's company, Berkshire Hathaway. Those A-class shares trade for about $250,000 a piece. So clearly no stock splits going on there. And ironically, too, recognizing that puts the shares out of the range of most investors, they created a number of years back a second class of shares, the B class, which traded a fraction of that price. But even those shares aren't exactly a bargain. They trade for about $170. So,
wow.
Yeah.
Yeah, you're right. It used to be something that if your price got over a certain amount of money, companies were just nervous that people would be scared off. So it's interesting that these companies kind of have thrown out the window.
Yeah.
Yeah. Well, thanks for being here, Mike.
Sure.
Very interesting.